Hello everyone, and welcome. Today, we're diving into Must Know 101 for Stock Market Dummies. Whether you're completely new to investing or just want to understand how businesses measure success, this video is designed to guide you through the essential financial terms and metrics that every beginner should know. We'll start with the basics, terms like revenue, profit, and expenses. Then, once we've built that foundation, we'll dive a little deeper into how investors actually use financial metrics to evaluate companies. Let's begin with revenue. Revenue is the total amount of money a company makes by selling its goods or services. For example, if Apple sells 1 million iPhones at $800 each, that's $800 million in revenue. You might also hear it called sales, or top line, because it's literally the top line of a company's income statement. It shows the raw amount of money coming in, but not how much of that the company actually keeps. Next, we have the cost of goods sold, or COGS. This is the cost a company pays to produce the products or services it sells. It includes things like raw materials, labor, and factory overhead. Knowing the COGS is important because it helps us understand how efficiently a company is producing what it sells. If COGS is too high, the company may not be making much profit. Gross profit is the money left after subtracting COGS from revenue. For instance, if a company makes $100 in revenue and spends $60 on production, its gross profit is $40. Gross margin goes one step further and tells us what percentage of the revenue the company keeps after production. In this case, that would be 40%. These numbers help investors see how profitable a company's core operations are. Operating expenses, or OPEX, are the day-to-day costs of running a business. These include salaries, rent, utilities, and marketing. When you subtract OPEX from gross profit, you get operating profit. Understanding these expenses helps investors evaluate how well a company manages its resources and controls costs. Net income is the company's final profit after all expenses, taxes, and interest have been subtracted. This is often referred to as the bottom line. If it's positive, the company is profitable. If it's negative, the company is operating at a loss. Net income is one of the most important figures investors look at. It shows the company's true profitability. Earnings per share, or EPS, tells us how much profit is assigned to each share of stock. For example, if a company earns $1 million and has 500,000 shares, its EPS is $2. EPS helps investors compare companies of different sizes. It gives a clearer picture of how much value each share holds in terms of earnings. Now that we've covered the core financial terms, let's take a step further. Understanding the basics is like learning the alphabet, but now it's time to start forming words and reading the bigger picture. This next part of our journey focuses on what financial metrics really tell us. These numbers help you assess whether a company is growing, efficient, or overvalued, and whether it's worth investing in. Let's start with the PE ratio. It shows how much investors are willing to pay for each dollar of earnings. You calculate it by dividing the stock price by earnings per share. For example, if a stock is $150 and its EPS is $5, then PE is equal to 150 divided by 5, which is 30. A PE ratio between 10 and 20 is usually considered healthy. If it's between 20 and 30, the company might be slightly expensive, but still worth it if it's growing fast. Over 30? That's risky. Unless the company has very strong growth potential, it might be overpriced. EBITDA, often called EBITDA, stands for earnings before interest, taxes, depreciation, and amortization. That may sound complex, but it really just shows how much profit a company makes from its core operations before any extra costs are factored in. If EBITDA is over 20%, it means the company is highly efficient. Between 10 and 20% is average, and below 10% might be a sign that the company is struggling operationally. Return on equity, or ROE, tells us how effectively a company uses shareholder money to generate profit. You calculate it by dividing net income by shareholder equity. A strong ROE is usually 15% or higher. It's a great way to measure how well a company rewards its investors. The debt-to-equity ratio compares how much a company owes versus how much it owns. It gives us a sense of financial risk. A ratio between 0.3 and 0.6 is considered safe. Between 0.7 and 1.0 means you should keep an eye on it. If it's over 1.0, the company may be relying too heavily on borrowed money. Still, context matters. Some industries naturally operate with more debt than others. Profit margin shows how much profit a company keeps from every dollar of sales. A margin above 15% is very strong. Between 10 and 15% is typical, and below 10% means the company isn't retaining much profit. This metric also varies by industry. For example, tech companies usually have higher margins, while grocery stores operate with lower ones. Now that you know both the basic terms and the more advanced metrics, you're ready to put your knowledge into action. Choose 2 companies you're familiar with, like Apple and Coca-Cola. Look up their PE ratio, ROE, debt-to-equity ratio, and profit margin. Then, compare those numbers and decide, would you invest based on what you've learned? Try to put your new knowledge to work with this practical exercise. To wrap up, understanding financial terms and metrics is one of the most powerful tools you can have. It allows you to read between the lines, assess a company's health, and make confident, informed decisions. Whether you're managing your own money or just want to learn how the world of finance works, this knowledge puts you in control. Thank you for being here today. If you found this helpful, don't forget to like, subscribe, and share with someone else who's starting their journey too. See you in the next video.